watching the latest news from financialmirror.tv. A growing number of European governments are following Germany's lead of opposing any shared bank rescue fund by offering guarantees to savers in a frantic effort to calm fears among investors. In the course of a hectic weekend, leaders of Europe's four biggest economies, Germany, France, Britain and Italy, decided against a coordinated bank bailout, while vowing to stabilise markets. But investors slashed risk-form portfolios on Monday, seeking more concrete steps from authorities, perhaps in the form of coordinated interest rate cuts from next weekend's G7 meeting. Russia halted share trading for an hour on Monday after its benchmark index sank more than 14% to a three-year low, while Gulf equities crumbled and South Korea said it wanted crisis talks with Japan and China. Sweden said it would expand deposit guarantees and the central bank will raise the amount of loans offered to banks. The Spanish government said it was prepared to guarantee deposits unilaterally if the union did not act, while the various moves were putting intense pressure on Britain, which faces the prospect of a drain in deposits from its banks. Berlin was working on a new plan to protect the entire German bank sector, not just individual institutions that came under stress. But this Plan B would not be a Europe-wide solution to mirror the $700 billion rescue package agreed in the United States on Friday night. France's BNP Paribas scooped up the assets of Fortis in Belgium and Luxembourg for €14.5 billion, or nearly $20 billion, to stem a cash drain on Fortis and Dexia. This will make Belgium the French bank's biggest shareholder with a 12% stake. BNP will get 75% of Fortis Bank Belgium and all the group's Belgian insurance operations, and has agreed to buy 66% of Fortis Bank Luxembourg in exchange for a smaller stake to be held by the state of Luxembourg. Meanwhile, EU finance ministers meeting in Luxembourg said executive pay should be linked to performance and come under the effective control of shareholders, with Belgian Prime Minister Yves Le Terme insisting that the outgoing head of Fortis, Herman Verwilst, forego a €4 to €5 million payoff. On a frantic weekend, Germany also clinched a revised rescue deal for lender Hypo Real Estate that will see commercial banks and insurers provide €15 billion in liquidity on top of an initial package of €35 billion. Franco-Belgian financial group Dexia, meanwhile, sought to dispel concern that uncertainty over the German salvage plan for troubled Hypo Real Estate would create new problems for the bank rescued with public money. For its part, the US Federal Reserve was pushing Citigroup and rival Wells Fargo to compromise over their competing bids for hobbled bank Wachovia that could result in them carving up its assets. Pope Benedict said on Monday that the global financial crisis showed that faith in God trumped a lifetime spent pursuing material wealth. The pontiff said that the collapse of the great bank shows that money disappears. It's nothing, he said. The pontiff, using a biblical metaphor, said people who ignored the word of God to pursue wealth had effectively built their homes on sand instead of on a solid foundation of faith. He said that whoever builds his life on this reality, on material things, on success, builds his house on sand. Only the word of God is the foundation of all reality. The credit crisis has also threatened weak bulk shippers and shipyards, as access to credit is the lifeblood of maritime trade, and the credit crunch has largely cut off that supply. The outlook is worst for the bulk shipping industry, which hauls raw materials such as iron ore, grain and cement. More than 90% of the world's traded goods by volume is carried by sea. Robust growth in markets like India and China spurred a race to build new ships, creating three-year backlogs in shipyards. Polis Hadjianu, chief executive of Safe Bulkers, said that some in the newer shipyards in South Korea and China are going to suffer a great disappointment. They'll not be able to deliver a number of ships, while smaller shippers will also have trouble financing the ships they ordered. Analysts also argue that the credit crunch may force governments in Asia to slash infrastructure spending on roads, railways, bridges and airports. Oil hit an eighth-month low of $90 a barrel on Monday, pressured by expectations that the global credit crisis will bring a sharp fall in oil demand. US light crude for November delivery fell in its fourth day of losses, its lowest since early February, while prices have dropped nearly 40% from a peak of $147.27 on July the 11th. Oil demand in the United States, the world's top energy consumer, has slumped this year under the weight of record prices, while consumption in Japan and Europe has also weakened. There are already questions over China, where rapid economic growth helped trigger oil's rise from just $20 a barrel in 2002. With oil prices sliding, OPEC member Iran said $100 a barrel was too low and urged cartel members to respect their quotas to prevent oversupply from worsening. Demand has declined by 3 million barrels per day as a result of falling requirements in the main consuming countries, while supply remained steady. The dollar's rise versus the euro has also added to pressure on commodities, which are mostly priced in the US currency. Coffee, sugar, corn were down sharply. Copper fell almost 7% to a 20-month low. But gold, a traditional safe haven in turbulent times, firmed at nearly $850, recouping earlier losses mainly due to the strong dollar. New car sales in Britain suffered their worst fall since 1999 by dropping more than 21% in September from the start of the year, with the credit crunch keeping buyers out of showrooms. Car registrations were fewer than in September 2007, while new registrations fell an annual 19% in August to record their weakest showing since 1966. Industry watchdogs say that government action is needed to restore consumer confidence and boost demand in the real economy. September is normally a bumper month for the industry due to the change in registration number plates, but poor sales have already forced several car manufacturers to reduce shifts or lay off workers. Thank you for watching FinancialMirror.tv.